The economy, a bumpy ride. We live in uncertain economic times. Inflation is rising. Prices for everyday goods and services are going up. People are worried about their money. It's understandable to feel anxious. We've seen stock market volatility. Interest rates are fluctuating. The future feels unpredictable. But remember, we've been through tough times before. Economic downturns are a part of the cycle. What matters most is how we react and adapt. Panicking won't help. Instead, we need to be smart and strategic with our finances. This means taking a hard look at our spending habits. It also means exploring different ways to protect and grow our money. One investment that often comes up during times of economic uncertainty is gold.
Gold, a safe haven. Gold has a certain allure. It's shiny, it's precious, and it has a long history as a form of currency. For centuries, people have viewed gold as a safe haven in times of trouble. When paper money loses its value, gold is often seen as a stable alternative. This is because gold has intrinsic value. It's a physical commodity with real-world uses. During economic downturns or periods of high inflation, investors tend to flock to gold. They see it as a way to preserve their capital. The idea is that even if the value of the dollar declines, the value of gold will hold steady or even increase. This makes gold a popular choice for investors looking to hedge against inflation. However, it's important to remember that gold is not without its risks. Like any investment, the price of gold can fluctuate. It's not a guaranteed way to make money. In fact, there have been periods where gold has performed poorly. It's crucial to understand both the potential benefits and risks before investing in gold.
Inflation, the silent thief. Inflation is a word that strikes fear into the hearts of many. It's a silent thief that slowly erodes the value of your hard-earned money. Simply put, inflation is the rate at which prices for goods and services increase over time. This means that the same amount of money buys fewer goods and services than it did before. When inflation is high, your money buys less. It erodes the purchasing power of your savings, making it harder to maintain your standard of living. Imagine you could buy a loaf of bread for $1 last year. With inflation, that same loaf of bread might cost $1.10 this year. Over time, this adds up and can significantly impact your budget. Inflation can be caused by a variety of factors. It's not just a single event, but a complex interplay of various elements in the economy. Sometimes it's due to an increase in the cost of raw materials. When the price of essential inputs like oil or metals goes up, the cost of producing goods also rises, leading to higher prices for consumers. Other times, it's driven by increased demand or a decrease in supply. For example, if there's a surge in demand for housing but not enough homes available, prices will go up. Whatever the cause, inflation can have a significant impact on your finances. It affects everything from the cost of groceries to the price of a new car. It eats away at your savings and reduces your standard of living. If your income doesn't keep pace with inflation, you may find it harder to make ends meet. That's why it's essential to find ways to protect your money from inflation. Being proactive can help you mitigate its effects and preserve your financial health. Investing is one way to do this. By putting your money into assets that have the potential to grow faster than inflation, you can safeguard your purchasing power. By putting your money to work in assets that have the potential to grow faster than inflation, you can preserve and even increase your purchasing power over time. This might include stocks, real estate, or other investments that historically outpace inflation. Diversifying your investments is also crucial. A well-diversified portfolio can help spread risk and increase the chances of achieving returns that outpace inflation. Consider inflation-protected securities, such as Treasury inflation-protected securities, TIPS. These are designed to increase in value with inflation, providing a hedge against rising prices. Real estate can also be a good hedge against inflation. Property values and rental income tend to rise with inflation, providing a potential source of income and capital appreciation. Investing in commodities like gold and silver is another strategy. These tangible assets often retain value during inflationary periods. Long-term financial planning is essential. By setting clear financial goals and regularly reviewing your investment strategy, you can stay ahead of inflation and secure your financial future. Consulting with a financial advisor can also be beneficial. They can provide personalized advice and help you develop a strategy tailored to your specific needs and risk tolerance. In conclusion, while inflation is a silent thief, that can erode your purchasing power, there are ways to protect yourself. By understanding the causes of inflation and taking proactive steps to invest wisely, you can preserve and even grow your wealth over time.
Gold in your portfolio, a balancing act. When it comes to investing, diversification is key. You've heard me say it a million times. Don't put all your eggs in one basket. This holds true for gold as well. While gold can play a role in a diversified portfolio, it shouldn't be your only investment. Think of gold as a small part of a larger strategy. Gold can act as a hedge against inflation. It can also provide stability during times of economic uncertainty. However, gold doesn't generate income like stocks or bonds. It also doesn't have the same growth potential as other investments. Therefore, it's best to allocate a relatively small percentage of your portfolio to gold. How much gold should you own? That depends on your individual circumstances, risk tolerance, and investment goals. A financial advisor can help you determine the appropriate allocation for your specific situation. Gold today. What's the price? The price of gold is constantly fluctuating. It's influenced by a variety of factors, including supply and demand, global economic conditions, and investor sentiment. As of November 2023, the price of gold is hovering around. However, it's important to remember that past performance is not indicative of future results. Just because gold has performed well in the past doesn't mean it will continue to do so in the future. The price of gold can be volatile, and there's no guarantee that it will hold its value. Before investing in gold, it's crucial to do your research and understand the factors that can impact its price. Don't let the allure of gold cloud your judgment. Make informed decisions based on your financial goals and risk tolerance. The future of gold crystal ball. Time. Predicting the future of gold is a fool's errand. There are simply too many variables at play. However, we can look at potential trends that could impact the price of gold in the years to come. Global economic growth, inflation rates, interest rates, and geopolitical events can all influence the demand for gold. Some analysts believe that gold could continue to rise in value as inflation persists and economic uncertainty lingers. Others are more cautious, pointing to the potential for rising interest rates to dampen demand for gold. The truth is, no one knows for sure what the future holds for gold. Instead of trying to time the market, focus on what you can control. Invest for the long term, diversify your portfolio, and don't let emotions dictate your investment decisions. Gold's risks, not so shiny after all. While gold can be a valuable addition to a diversified portfolio, it's essential to be aware of the risks involved. As with any investment, there's no guarantee that you'll make money by investing in gold. The price of gold can be volatile, and you could lose money, especially in the short term. Unlike stocks or bonds, gold doesn't generate income. You're relying solely on the price of gold to appreciate in value. Additionally, storing physical gold can be costly and inconvenient. You'll need to find a secure location and potentially pay for insurance. Before investing in gold, carefully consider your investment goals, risk tolerance, and overall financial situation.
Beyond gold, other ways to fight inflation. Gold isn't the only way to protect your money from inflation. In fact, there are several other investment options that may be more suitable for your needs. Real estate, for example, has historically been a good hedge against inflation. As prices rise, so too does the value of your property. Stocks can also provide inflation protection. Companies can often pass on increased costs to consumers in the form of higher prices. This can help to maintain the value of your investments in an inflationary environment. Other options include Treasury inflation-protected securities, commonly known as TIPS, and commodities. The key is to diversify your investments and create a portfolio that aligns with your financial goals and risk tolerance.
The golden question: is it right for you? So is gold a smart investment to combat inflation? The answer, as with most things in personal finance, is it depends. Gold can play a role in a diversified portfolio, providing a hedge against inflation and economic uncertainty. However, it's not a guaranteed way to make money, and it's not suitable for everyone. Before investing in gold, ask yourself these questions. What are my investment goals? What is my risk tolerance? How much can I afford to lose? Do I understand the factors that can impact the price of gold? If you're unsure, consult with a qualified financial advisor who can help you make informed investment decisions. Remember, investing is a marathon, not a sprint. Make sound decisions, stay disciplined, and don't let emotions guide your actions.
Diversification. Don't put all your eggs in one basket. Diversification is the cornerstone of a sound investment strategy. It simply means not putting all your eggs in one basket. Instead, you spread your risk across different asset classes, such as stocks, bonds, real estate, and yes, even gold. This way, if one investment performs poorly, the others can help to cushion the blow. Imagine you invest all your money in a single stock. If that company goes bankrupt, you could lose everything. However, if you had diversified your portfolio, the loss from that one stock would be offset by the gains in your other investments. Diversification helps to mitigate risk and protect your portfolio from major losses. Remember, diversification is your best defense against the unknown. Expert opinions, what the pros say. Financial experts have varying opinions on the role of gold in a portfolio. Some believe that gold is an essential hedge against inflation and economic uncertainty. Others view it as a speculative asset with limited upside potential. It's important to consider a range of perspectives before making any investment decisions. Renowned investor Warren Buffett, for example, has famously been skeptical of gold. He prefers investments that generate cash flow, such as businesses and real estate. On the other hand, Ray Dalio, founder of Bridgewater Associates, has advocated for holding a small allocation of gold as a hedge against economic instability. Ultimately, the best approach is to educate yourself on the pros and cons of gold and determine if it aligns with your individual investment philosophy and goals. The bottom line: gold, inflation, and your wealth. Gold has been a store of value for centuries, and it can play a role in protecting your wealth from inflation. However, it's essential to approach gold investments with a healthy dose of caution. Don't buy into the hype or let emotions cloud your judgment. Gold is not a get-rich-quick scheme. It's a long-term investment that should be approached strategically. Consider your financial goals, risk tolerance, and overall investment strategy before adding gold to your portfolio. Remember, diversification is key. If you're unsure about how to incorporate gold into your investment plan, consult with a qualified financial advisor who can provide personalized guidance. By making informed decisions and staying disciplined, you can navigate the complexities of the market and work towards achieving your financial goals.